Last week, something happened in the gold and silver markets that should not have happened, not even once in a lifetime. What we saw was so extreme that many traders are calling it a once-in-history moment that rewrote the rules overnight. Gold and silver didn't just fall, they collapsed in a way that stunned even veteran investors. Prices moved so violently that many people watching live charts thought their screens were broken. Silver recorded the largest single-day nominal drop in its entire trading history. Not a rumor, not an exaggeration, but a real data point that will be studied for decades. Gold followed closely behind, shedding value at a pace that wiped out trillions of dollars in hours. This wasn't slow panic selling. This was forced liquidation at a massive scale. Some analysts are calling this the first true Sigma 10 event in financial history. In simple terms, this move was statistically not supposed to exist. To put it in perspective, the math says an event like this should not happen within the lifetime of the universe, yet here we are, watching it unfold in real time. If you're wondering why this matters to you, stay with me, because next week could shock a lot of people. And what happens next may decide where gold and silver go for the rest of the year. Before we go deeper, if you follow precious metals or want real market insight without hype, make sure to like this video and subscribe to Bullion Alert HQ. It really helps the channel, and it keeps you ahead of moves most people only understand after it's too late. Now here's the part that made professionals raise their eyebrows. There were no circuit breakers triggered during this historic crash. Normally, markets are designed to pause trading when moves get too extreme, but this time, prices were allowed to fall freely without interruption. Several market watchers pointed out that the rules seem to apply only in one direction. When prices go up too fast, breaks appear, but when prices fall, the market is allowed to bleed. Silver dropped over 25% in a single day. That alone would be enough to make headlines, but this drop didn't stop there. At one point, silver was down nearly 38% from its highs. That is the kind of move that destroys leveraged positions instantly. Many people remember 1980, when silver collapsed during the Hunt brothers era. Back then, silver fell by about 50% in one day, but the dollar value of that drop was much smaller. This time, the dollar loss was far larger, making last week's move historically bigger in real terms. That's why so many seasoned traders are calling this unprecedented. Gold wasn't spared either. In less than 24 hours, gold erased roughly 15% of its value. When you combine gold and silver together, an estimated $15 trillion vanished from the market. That's nearly half of the entire US GDP, gone in a single day. And yet, here's where things start to get interesting. Despite the chaos, silver is still up for the year. Silver began the year around $71 an ounce, and even after the crash, it's trading higher than that. This detail is easy to miss, but it matters more than people realize. While paper prices collapsed, something very different was happening behind the scenes. Demand for physical metal was exploding. One of the largest private mints in the world reported something they hadn't seen since the lockdown years. Orders were coming in faster than they could process them. The CEO said demand for physical gold and silver is breathtaking. Those were his exact words, and that statement alone tells a powerful story. Dealers around the world started reporting low inventory warnings. Some even suggested physical silver could be completely sold out within days. At the same time, silver prices in China were trading nearly $40 higher than in the United States. That kind of price gap doesn't happen in a normal market. This creates a serious question that investors must face. If silver is crashing on paper, why is physical demand exploding? Some analysts say this was a healthy correction after an explosive rally. Others argue it was inevitable and necessary. But here's what most people overlook. Corrections don't usually trigger global physical shortages. Despite the fear on screens, buyers were stepping in aggressively. Every dip was being met with real money, not speculation. Many investors, including long-term stackers, openly said they were buying the dip. Some even said if prices fall further, they'll buy more. And while silver stole the spotlight, gold quietly held its ground better than expected. Several forecasts still place gold at $6,000 per ounce before the year ends. This brings us to the bigger picture that few are talking about. What if this crash wasn't the end, but the reset? Sometimes markets shake out weak hands before the next major move higher. History shows that the most violent drops often come before powerful rallies. Now zoom out for a moment and look beyond gold and silver. There's another metal that barely flinched during the chaos. Copper dropped less than 4% during the same period. In a market meltdown, that kind of strength stands out. Experts are warning that the world needs to mine more copper in the next 20 years than it has mined in the last 10,000. That statement alone should make you pause. Copper is essential for energy systems, data centers, electric vehicles, and modern infrastructure. Without copper, none of the future tech narratives work. Many analysts believe copper is positioned to go parabolic, not because of hype, but because supply simply cannot keep up with demand. There's also a growing political push to bring mining back to the United States. This changes the entire game for domestic resource projects. Policies focused on mineral independence are no longer theoretical. They are being written, signed, and enforced. This shift could mark the rebirth of American mining. And for investors paying attention, this may be a generational opportunity. As gold and silver prepare for what could be a shocking next move, the pressure on industrial metals continues to build. Next week may reveal which direction the market truly wants to go. We're only getting started because what comes next ties everything together in a way most people don't expect. Stay with me, because part 2 is where the real implications begin. As we move into the next week, the biggest mistake many people will make is assuming the chaos is over. Markets rarely deliver a shock this big without follow-up consequences. When volatility reaches extreme levels, it usually signals a transition, not a conclusion. The question is whether we're transitioning into fear or into opportunity. What most retail investors don't realize is that paper prices and physical markets are now telling two very different stories. This disconnect is growing wider by the day. On one side, futures markets show violent selling and algorithm-driven pressure. On the other side, real buyers are lining up for physical delivery. When physical demand keeps rising while paper prices fall, it creates tension that cannot last forever. Eventually, one side has to give. Historically, paper markets bend toward physical reality, not the other way around. That's why shortages often appear right after major price crashes. Premiums are already starting to creep higher across major dealers. This means even if spot prices fall, real-world costs may rise. Many investors will be shocked when they realize silver is harder to find next week than it was before the crash. And scarcity changes psychology very quickly. Fear makes people sell paper assets. Scarcity makes people hoard physical ones. This is exactly the environment where unexpected price spikes can appear. They don't announce themselves, they happen suddenly. Another key factor many are ignoring is global demand outside the United States. The US does not control the entire precious metals market. When silver trades significantly higher in Asia, metal flows toward those markets. That drains supply from Western dealers even faster. At the same time, central banks continue accumulating gold quietly. They don't chase headlines, they position early. Central banks are not emotional traders. Their actions often signal long-term confidence in hard assets. This brings us back to the idea of trust. Every major metals rally begins with a loss of trust somewhere else. Whether it's currency stability, government debt, or market fairness, something always cracks first. Last week's event shook confidence deeply. People saw markets move in ways that felt unnatural, and once trust is damaged, it's very hard to repair. This is why next week matters more than most people think. It's not just about price, it's about belief. If gold and silver stabilize while demand remains strong, confidence could snap back fast. That's when late buyers rush in. But if prices dip again and physical shortages worsen, panic buying becomes a real possibility. Both paths lead to volatility. Now let's talk about copper for a moment, because it connects directly to this story. Copper is quietly signaling something powerful. Despite all the chaos, copper held up remarkably well. That tells us industrial demand remains strong. Data centers, AI expansion, electrification, and infrastructure projects are not slowing down. They are accelerating. Copper is not optional for modern economies. Without it, growth stalls. This is why so many experts believe copper faces a supply crisis, and supply crises don't resolve gently. Add in political pressure to secure domestic resources, and the picture becomes clearer. America wants control over its materials. This shift favors US-based mining projects, especially those with existing infrastructure and past production history. While gold and silver grab headlines, copper builds quietly beneath the surface. Smart money often moves before the crowd notices. At Bullion Alert HQ, the goal is not to chase hype. It's to understand positioning before the move becomes obvious. That's why weeks like this are so important. They reveal stress points that normal markets hide. When stress appears, opportunity often follows, but only for those who stay calm and informed. As we head into the next trading week, expect emotions to remain high. Fear and excitement will trade places rapidly. Do not be surprised if prices move sharply in either direction. This is not a normal environment. What you should watch closely is physical availability, dealer premiums, and global price gaps. Those signals matter more than headlines. If physical silver becomes hard to source, sentiment can flip overnight. That's how shocks happen. Gold, meanwhile, continues to behave like insurance. Quiet, steady, and waiting for its moment. Many people will look back at this period and say the signs were obvious, but in real time, clarity is rare. That's why staying engaged and informed matters so much. Especially now. Before you go, I'd love to hear your thoughts. Where do you think gold and silver are heading next week? Drop your opinion in the comments below and let's discuss it together. Different views help everyone see the bigger picture. If you found this breakdown helpful, share this video with someone who follows the markets. These conversations matter more when uncertainty is high. Thank you for watching Bullion Alert HQ. Stay alert, stay curious, and I'll see you in the next one.